Welcome to the Canadian Investors course, Session 15, Rules-Based Investing, Building a Portfolio by Bringing Together Fundamental and Technical Analysis. Slide 2 contains the terms of use and disclaimer, which we would request that you read. Let's set our perspective straight. There are many versions of rules-based investing. Just because you're told a rules-based technique is being employed, it doesn't mean it is true rules-based investing. We advocate that advisors should investigate other versions of rule-based investing solutions with the exception of the buy and hold static portfolio. We believe that investors should buy and hold a set of rules or a discipline, in other words, buy and rule, not buy and hold a rigid set of pie chart portfolios. Refer to previous lessons. With most likely the 30-year bull market in bonds or falling interest rates coming to an end, the era of buy and hold is most likely in question. Although there is the argument that over a multi-decade period, markets recover and go to new highs, investors who don't have that long to wait may not have a long enough investment horizon to be able to see the benefits of that. This course's version of rule-based investing is not focused on constantly outperforming the underlying markets which you're trying to invest in. It is focused on long-term growth through fundamental and technical analysis to minimize losses that can occur, for example, in bear markets. We don't want to participate for 2 to 5 years in a growing market just to have a major part of it taken away in a bear market and then spending the next 2 to 4 years trying to get it back. This is stressful and most investors can't stomach it. So let's create a personalized investment policy statement, and to do that, refer to Section 13. An IIROC advisor should always create an investment policy statement for you before they start in the process of investing. Your IIROC advisor, along with yourself, should determine what your current asset allocation mix will be based on A, the fundamental conditions of the economy and valuations of the market themselves relative to historic norms, B, technical analysis that determines market trends, C, both fundamental and technical analysis used together to determine individual security selection and investment into the portfolio based on the asset allocation chosen, in other words, the ratio of cash, fixed income, and equities. And D, monitor market indicators and be prepared to shift security allocation ranges as necessary. This important work is critical to a safety approach to investing. Note, steps in A and D are constantly repeated, whether it be weekly, monthly, or quarterly. This is your IIROC investment advisor working for you. And you should be asking them how they're going to do that. So, let's take an example of rules-based investing. Let's take investors John and Ingrid Doe, both 55. They have a $500,000 portfolio in a joint account. After doing their financial plan and risk tolerance analysis, the advisor presented this IPS to John and Ingrid. Everybody agreed they should have a cash ranging from 10 to 60%, fixed income 20 to 60%, and equities 20 to 70%. These are strict guidelines for managing the portfolio for this couple. Yours may be different. Please note that the guidelines will change also as time goes by and their risk tolerances change. Note, please refer to sessions 1, 2, and 4 as appropriate. These sessions deal with the introduction to income and equity definitions and equity selection. So the example begins with understanding security selection, which stocks, bonds, etc. should be held in the portfolio. The different values, the different types of ratio analysis will be used to find the fundamental value of the stocks. Then market or economic conditions should be taken into account, and technical analysis will determine the critical tactical asset allocation range for the portfolio. This range must lie within the restricted strategic established range defined just a little bit earlier. The CIC course was designed to help investors understand the various types of security analysis. This is not a portfolio manager or security analyst course, which require many courses and years of experience. Most IROC licensed advisors have access to this research and can create a complete list of portfolios with track record. Continuing the example, below is one form of technical analysis that an IROC advisor has access to. It's called basically moving average crosses. In the 1930s, the Dow Jones Index chart is presented below. There are two moving averages, the green line and the red line. The green line is the shorter term moving average, and the red line is the longer term moving average. When the green line crosses the red line on the downslope, it's a sell signal. When the green line crosses the red line in an upward direction, it becomes a buy signal. Notice that it could take a long time before you change directions. Sometimes it can occur twice or more in a year. The market itself triggers the change. You just follow it. You don't know when it's going to happen. Look at all the decades since 1929 in Session 4. You'll be amazed. This is 29 to 40. You can see that there was a huge drop in 1929, followed by several changes of direction over the next couple of years, with only a little bit of an upward move in the markets, but with enough volatility that basically buy and hold would have been a disappointing experience. If an investor had been unfortunate to have invested all their money in the market at the very top in 29, then practiced rules-based investing for the remainder of the decade, they would have ended the decade with a return of over 6%, which isn't bad. But the buy and hold investor would have had a total loss of over 60% of their money during the time period and wouldn't have broken even until 1954, 25 years later. This is an important example why rules-based investing is so important, because most investors have an approximately 25 to 30 year timeline to make their money if they're planning to use it in retirement. Now, look at the period from 1929 to 1940 again. The government yields moving average caused the green lines to cross up through the red line, and still a fixed income allocation would drop to 20%. In fact, this occurred in November 2016, and bonds still remain a sell to this day. 10 to 20-year bonds have lost 10% since then, as of February 2017, and there may come a time when Joe and Ingrid will hold 60% cash or money market in the portfolio to protect themselves. So in a rules-based investment environment, typically a portfolio is going to contain no more than 30 stocks. If you remember from earlier sessions where the efficient frontier is 25 to 30 stocks, that's where that idea comes from. And are there other tools that the advisor can use to limit downside risk? Certainly. One technique is to use stop losses. So ask your current advisor if they can place a stop loss on your investment, including any mutual funds you hold. You'll soon discover whether you have a full service advisor or not. There are multiple forms. There's straight stop losses, which is stopping at a price, and you can also use trailing stop losses, which if the stock or the security continues to go up, the stop loss climbs with the security. When it starts to fall, the stop loss is locked, and if it falls from the high point by a given percentage, then you get sold out of the stock. When buying stock for the portfolio, you can place a stop loss for US stocks with a trailing stop loss, and a trailing stop loss for Canadian stocks automatically. They're usually placed with no more than 1 month period, up to 2 months, allowing the advisor to renew and review the stop loss order. So if you buy a stock at $50 a share, you can place, for example, a 1-month $45 stop loss order that will limit your downside. If you get sold out on a fall of 45, you can decide whether this stock should be repurchased or not, either then or at some later date. This is a very conservative strategy. It prevents stocks in your portfolio from falling 30 to 60%, and then you have to hang in there until it recovers. Investors only need to be successful 60% of the time with their stocks to do well, but it'd be wise to limit the downside for the other 40%. If the stock market goes higher, then you don't get stopped out. Rules-based investing includes the usage of this stop-loss practice. Use of this technique illustrates how valuable a full-service IROC advisor can be using a fee-based investment account. Please refer to Session 9, the investment industry and fees, to understand how the IROC advisor compares with the rest of the industry. A rules-based investing summary. First of all, create a financial plan, preferable but not totally essential to the IPS formation. Complete the investor's risk tolerance. Calculate the required risk to achieve the rate of return goal for the portfolio. Don't take more risk than you need to. Construct an IPS. Must have strategic allocation ranges. Based on fundamental and technical and economic analysis, determine a tactical allocation within the restricted range. Determine what percentage of cash, fixed income, and equity should make up the portfolio. Create the investment portfolio with securities selected through the analysis. When purchasing individual stocks or ETFs, place a 5 or 10% stop loss on each security to protect the downside. Monitor and repeat Step 5 and Step 7 on a regular basis, and review the IPS allocation restrictions on an annual basis. That's the end of Session 15, Rules-Based Investing.